Here's a question that was asked on Wall Street back in 1940, and nobody's had a good answer since. A visitor was being given a tour of New York Harbor. A broker pointed out all of the yachts bobbing in the water. He said, "Those belong to the bankers. Those over there belong to the investment advisors." Now, the visitor looked around the harbor and asked the obvious question: where are the customers' yachts? Now, that question became the title of a book written by Schwed. And it's still 85 years later, it was written in 1940, completely relevant. Because the financial industry has a long, well-documented history of collecting fees first and worrying about your return second. I'm Chris, an investment advisor at First Shelbourne here in Comac, New York. Before we begin, a quick disclaimer. Today's video is for educational purposes only. It isn't financial advice or specific recommendation, so please consult with your own professional before taking any action. Now, here's what you're going to learn in the next few minutes. 1. The industry advisory fee sits at approximately 1.02% of assets under management per year. That's according to a 2023 survey by Advisory HQ. 2. When you layer in hidden fund costs, think actively managed mutual fund expense ratios, the all-in fee at many firms quietly creeps past 1.75 to 2% annually. And 3, according to the SPIVA scorecard, that's the S&P Dow Jones Indices official persistence report, over a 20-year horizon, roughly 94% of actively managed large cap funds have underperformed their benchmark index. Now, on $500,000 portfolio, the difference between a 0.5% fee and a 2% fee compounded over 20 years could exceed $500,000 in lost wealth. Let that sit for a second. The fee itself can cost you as much as your original investment. Fred Schwed wasn't an economist. He wasn't a regulator. He was a trader who lost his own money in the 1929 crash. And then he spent years watching Wall Street keep on humming, collecting commissions, charging fees, and selling yachts. His book is funny, genuinely funny, but the underlying observation is forensic. Schwed's core argument was this: the financial industry is one of the only industries in the world where the service provider gets paid regardless of results. A contractor doesn't get paid if the house doesn't get built, but historically, an investment advisor collects their percentage whether markets go up, down, or sideways. That isn't inherently wrong. Fiduciary advisors, legally bound to act in your best interests, provide real documented value. Behavioral coaching, tax-aware planning, estate coordination, keeping clients from panic selling during downturns, and portfolio management. Research from Vanguard in their framework called Advisors Alpha estimates that a good fiduciary advisor can add approximately 3% in net returns annually, not from stock picking, but from behavioral management and planning. So fees in the right context are worth paying. The question is, how much? Here's where it gets complicated. Most investors see one number on their statement, the advisory fee. So let's say it's 1%. That might feel reasonable. That's what you agreed to, but that isn't the whole bill. Many advisors, not all, but many, build portfolios using actively managed mutual funds. Now, those funds carry their own internal expense ratios. According to the Investment Company Institute's 2023 fact book, the average expense ratio for an actively managed equity mutual fund is approximately 0.66%. Add that to a 1% advisory fee, and you're already at 1.66% before any transaction costs, sales loads, or account minimums. Now, some firms push this even further. Wrap accounts, model portfolios built on proprietary high-fee products, annuities with surrender charges baked in. The all-in cost at some firms quietly approaches 2% annually or higher. Now, here's the forensic problem with that. Historically, those high-fee active funds haven't earned their premium. The SPIVA scorecard published by S&P Dow Jones Indices is the most comprehensive benchmark persistence study in the industry. Let's do the math, and let's make it concrete. Take a $500,000 portfolio. Assume a 7% gross annual return, a reasonable long-term historical approximation for a diversified equity portfolio, per data from NYU's Damodaran database going back to 1928. At 0.5% in annual fees, a fiduciary-focused fee structure, the portfolio grows to approximately $1.74 million over 20 years. At 1%, the industry advisory fee alone, it's approximately $1.57 million. And at 1.75%, a common all-in total, when you include fund costs, you're looking at roughly $1.37 million. And at 2%, not uncommon when you add up every layer, the ending balance falls to approximately $1.22 million. The difference between the lowest and highest fee scenario, over $500,000, gone. Not lost to market risk, not lost to a bear market or a recession, lost to fees. Fiduciaries often observe that clients focus intensely on market risk, the possibility their portfolio drops 20% in a crash, but historically, fee drag is quieter and more certain than market volatility. Markets recover, fee compounding doesn't reverse. So here's the counterintuitive part, and it matters. There's nothing wrong with paying for good advice. There's something wrong with paying more and getting less. In most industries, price signals quality. A better surgeon charges more. A better architect charges more. But in investment management, the data doesn't support that relationship. The SPIVA report, the Morningstar Active Passive Barometer, and decades of academic research, including foundational work by William Sharp at the Stanford on the arithmetic of active management, all point to the same conclusion. Higher fees in investment management have historically been associated with lower net returns, not higher ones. That's the paradox Fred Schwed was pointing at in 1940. And it's still true. Now, and this still matters, doing it yourself doesn't automatically solve the problem either. The behavioral finance literature is unambiguous on this. Individual investors left to their own devices have historically underperformed even funds they invest in because of poorly timed buying, panic selling, and the absence of a structured plan. J.P. Morgan's Guide to the Market's data consistency shows that the average individual investor has historically earned significantly less than the market index, not because of fees, but because of behavior. So the answer isn't no advisor. The answer is a fiduciary, transparent fee advisor who isn't also generating revenue through the products they recommend. So Fred Schwed asked, where are the customers' yachts in 1940? Well, 85 years later, the SPIVA report is essentially answering this question every single year. Now, if you want to understand what you're currently paying, not just the number on your statement, but the full cost stack, that's a conversation worth having. Check the link below at firstshelbourne.com, and I feel happy to answer any questions you may have. Everyone, take care. Have a great day.